Welcome to CRE Fast 5, where we detail hot topics in commercial real estate in 5 minutes or less. I'm Carly Iacono, and tonight we are talking about sale-leaseback transactions. Now, sale-leasebacks are nothing new, but as the credit markets continue to tighten, they're becoming an increasingly relevant option for business owners who need to unlock maximum equity. So we're going to run through what a sale-leaseback transaction is and go through some considerations and pros and cons from both the owner-user perspective and also from the potential buyer or investor standpoint. Let's jump in. First, a sale-leaseback transaction is one in which an owner-user sells off the real estate and immediately leases it back, thereby becoming the tenant. Pretty basic. So if it's the American dream to own real estate, we always want to control our destiny, control our property. Why would a company want to do this? There are a lot of reasons. Let's go through them now. The first is 100% financing. What I mean by that is if you were to go to the bank and do a refi or get additional equity out of your current property, you're probably looking at, in today's market, 55% loan to value. Maybe 4 months ago that was 65%, but nothing close to what you can unlock by doing a sale-leaseback transaction. You are actually getting 100% of the value of your property that is currently tied up in an illiquid form. The second is dramatically improving your balance sheet. So you are taking a long-term non-liquid asset and converting it immediately to working capital. You're also taking a liability, which is your mortgage, and converting that to an operating lease, which is an off-balance sheet transaction. The third thing are the tax benefits. Now, of course, I'm not an accountant, I'm not a tax advisor, but how this works, your operating lease can be 100% written off as an expense instead of a partial deduction that you would get from mortgage interest. So potential huge tax savings there just by converting the structure. The fourth is maintaining control. So sale-leasebacks are really designed to mirror ownership, and you can structure this in any way that works best for your business. So if you wanted to have a 20-year base term with another 50 years of options, that is a very long time horizon to control your property and continue operating your business. So those are some benefits. Let's go through some considerations. The first is your rent level. Now, it goes without saying that the higher your rent, the higher your net operating income that you're offering to an investor, the higher your proceeds are going to be. However, be very mindful that this rent is actually sustainable. Most investors will look at a rent to sales ratio, and that varies by asset class as to what's considered acceptable or safe, but you know your business best from the owner-user perspective, so make sure that the rent is truly sustainable. You also need to make sure that it is somewhat in line with market rents. Again, a savvy investor is going to compare your rent and decide for themselves if, number one, your space is releasable should you ever leave at current rates, and two, if they think your business can sustain it. So from both perspectives, be very mindful of the rent amount that you are offering. The second is the strength of your company. Now, if you're a local operator, maybe you have one location, maybe you have two, it's a little more difficult to get interest from a sale-leaseback perspective. But if you're a multi-unit franchisee, maybe you're a mid-sized company, or you have any sort of credit or strength behind you, there will be tremendous demand if you do pursue a sale-leaseback. So be realistic about the strength of your company. Also be realistic about how long you can truly sustain the commitment that you are signing up for under that new lease. Third is the length of lease. Now, typically sale-leasebacks are going to be 15 years plus, with the most interest coming in the 20 to 25 year base term range with options. Now, the options are at the tenant's discretion. So I would say if you are on the tenant side, you want as many options as possible, maybe 20, 25 years of options if you can get them. But you want to structure that base term to be as long as you possibly can sustain it, but not too long to where it feels oppressive. The longer the lease term, typically the higher the proceeds. So what you're probably starting to see is flexibility is inversely proportional to price or proceeds on your deal. So it really is about hitting that sweet spot to where you don't feel that your business is too negatively impacted or too constrained, but you are still maximizing proceeds. So again, flexibility and proceeds typically are inversely related. The third thing to think about is the condition of your building. So the more management you as the tenant are willing to take on, the cleaner the lease structure, if your absolute net, that's the best possible, again, the higher your proceeds. But if you have an older building, maybe you're looking at a roof replacement in a few years, you need to factor that in, as that is going to be on you as the tenant. And if you're thinking about doing a double net structure where you're shifting some of that onto the investor in terms of the management and property maintenance, understand that your cap rate will then be higher, your proceeds lower. So really being realistic about the age and condition of your building is very important. The last thing is you want to build in as much flexibility as the tenant, new tenant, that you possibly can. I would really recommend considering a right of first refusal. So if your new buyer comes in, you complete your sale-leaseback transaction, everything's great, and maybe they go to sell in 3, 5, 10 years, whatever it is, it would be great to have an option to purchase back your real estate should something in your circumstances change. So right of first refusal is very important in your lease. And then your options, be mindful of the length of options and how many that you have, and the rent increases, actually both through the base term and options that you're agreeing to. All of this is very individualized, like I've been saying. So if this is a structure that you think might work for you or you'd like to explore further, please give us a call. We're happy to talk through your specific situation. On the opposite side of the coin, if you are an investor contemplating a sale-leaseback purchase, this can be a great way to get an experienced operator under a long-term lease and really get surety of income. So either side, give us a call. We'll talk you through. That was CRE Fast 5. I'm Carly Iacono. I look forward to seeing you again soon.